We can dig deeper into the balance sheet now and take a look at the classified balance sheet. A classified balance sheet groups together accounts of similar nature and reports them in a few major classifications. An asset is a resource of a business, and assets are generally grouped into 5 main categories on a classified balance sheet. So these are current assets, long-term investments, fixed assets, intangible assets, and other assets. A liability is an obligation of a business. Liabilities are generally classified in 2 main categories: current liabilities and long-term liabilities. And finally, equity is the difference between a company's assets and its liabilities. So it is generated from the following 2 sources: retained earnings and contributed capital. So a current asset is any asset that is reasonably expected to be converted to cash or consumed within 1 year of the balance sheet date. Common examples include cash, investments that will mature or be sold within a year, accounts receivable from customers, inventory, and other assets like prepaid insurance. Current assets are listed in order of their liquidity, which refers to the speed with which a resource can be converted into cash. So assets that are expected to be converted to cash in a period longer than 1 year are referred to as long-term or non-current assets. Now, on the liability side, a current liability is similarly an obligation that is reasonably expected to be satisfied within 1 year. Examples of current liabilities include accounts payable to vendors, salaries payable to employees, and taxes payable to taxing authorities. So even long-term debt, if it's maturing within 1 year, is classified as a current liability. Liabilities that are considered to be obligations in periods beyond 1 year are referred to as long-term or non-current.